Coronavirus outbreak 2020. The Federal Reserve decides to print trillions of dollars to revive the economy. In only a couple of months, trillions of dollars are injected into the collapsing US economy, but the outcome turns out to be far from what was hoped for. The inflation through the roof, breaking a 40-year record, and Fed continues to increase interest rates. We have already seen similar scenarios not once and not twice when uncontrolled money printing during difficult times lead countries to hyperinflation. Weimar Republic 1922, Hungary 1945, Yugoslavia 1992, Zimbabwe 2008, Venezuela 2016. The list goes on and on, but is the US heading toward the hyperinflation? What would happen to your money? Is there a way to avoid it? Stick around to find out. Imagine this. At the grocery store, you're getting about 11 cents less than you did just a year ago. That dollar covers 15 cents less on utility bills, and it worth 6 cents less on your rent and housing costs. That adds up to a pretty decent chunk of a change. That's how most of us see and feel the inflation. But what does inflation actually look like in official numbers? According to Bureau of Labor and Statistics, the peak of inflation was seen in June at 9.1%, in October it idled at 7.7%. The last time the inflation was the high the world was going through, the 1980s. But what about the CPI? CPI, or Consumer Price Index, is a basket of goods and services paid by people. CPI allows us to more accurately see the impact on inflation on people's lives. Again, according to the Bureau of Labor and Statistics, as of October, the CPI rose over 15% since Fed started printing money. When compared to the October of 2021, the increase is only 7.7%. If we look closer at the main categories of the CPI, we'll see that the price of buying groceries and dining out surged in October and are now 12% and 9% higher than a year ago, respectively. The overall food index gained almost 11%, and the gas prices are up by 17.5%. The situation looks really bad. But is it hyperinflation? Inflation is typically considered hyperinflation if prices rise by 50% or more in a month, which is annualized inflate rate of at least 1,000%. It is important to understand that hyperinflation is out of control inflation, and it can be triggered monetarily without further notice, even if the monetary policy and actions taken are valid. Hyperinflation is typically triggered by imbalance in the supply and demand for goods and services. It also can cause by a large increase in the nation's money supply. Historically, these types of increase have occurred when central government print massive amounts of money to fund wars or pay off the large debts. As the supply of the fiat currency spikes, its purchasing power plummets. Sounds familiar, but are we there yet? How many pieces of this scary puzzle are already in place, and how did we end up in this situation? Before we actually start panicking about hyperinflation, we must analyze why the US is enduring the high inflation in this first place. The two primary causes of hyperinflation are an increase in money supply not supported by economic growth, and demand supply inflation in which demand outstrips supply. We already know about the increased money supply, but I'll repeat. The pandemic was in many ways a very fertile ground for inflation. Huge government spendings, crippled businesses, and millions of people losing jobs. The initial shutdown workplace and uncertain shocked the market and tanked demand to a low of 0.1% inflation in May 2020, but since has risen back to a 40-year high of 9.1% in June 2021. The unprecedented government stimulus measures increased the nation's money supply from 15.4 trillion in January 2022 to more than 21.6 trillion by January 2022, and passed trillions of dollars into the hands of affected Americans. The second factor, this demand-supply problem, has emerged at the end of COVID. As social distancing has eased, demand has rebounded in context-sensitive sectors such as car purchases, transport, recreation, culture, holidays, and restaurants. Production capacity struggled to meet this unusual high demand and proceed accumulated orders, creating upward pressure on prices. Then the chip shortages happened, and yada yada yada. But the pandemic is only a part of the picture. Pandemic has ended, the economy is running again, but the prices keep climbing to new heights. Why? Now the Fed's policy of raising interest rates becomes a problem. The Fed increased its policy rates by 3.75 to 4% so far this year and is likely to increase them by another 2 or 2.5% in the coming months. As a result, the cost of borrowing has skyrocketed. For example, the average fixed rate on 30-year mortgage has already risen to 6.81% since the start of this year. At the same time, the government is reining in spending as a range of pandemic-era support programs are expiring. These Fed's actions will significantly slow the growth in consumer spending in 2023, which will ease the strain on supply chains. At the same time, higher mortgage rates will reduce housing prices, which have grown strongly during the pandemic. Finally, slowing demand will increase unemployment, which should lower the wages. As you see, the reasons for rising inflation are solid and will likely not go away anytime soon. But what if the US found itself in a hyperinflation? Hyperinflation has a couple of negative impacts on the economy. The first thing is panic. Panicked people can start hoarding stuff, buying everything they can while they still can. This causes supply shortages and the items become deficit. This deficit drives the prices higher and inflation follows. As the value of the dollar plummets, investors start panicking too, withdrawing money from banks and trading the falling dollar for other currencies or assets. These bank runs can undermine the stability of the US financial system, and selling pressure from investors can further drive down the value of dollar in foreign exchange markets. Once the value of the dollar falls so far that consumers can't afford to buy even basic goods and services, the economy and the dollar completely collapse. In the most extreme cases in hyperinflation, nearly all the wealth in the economy is destroyed, including many working-class citizens' life savings. Would life be like in the United States with an inflation rate of 20% or more? The countries of South America offers an insight into hyperinflation. It isn't unusual for South America shoppers to see the price of the bread increase between the time they enter a grocery store and the time they leave it. Savings lose their value. The only incentive is to spend. Paychecks are cashed immediately and turned into hard goods like washing machines, refrigerators, etc. And that's assuming they are available. Consumers are forced to pay cash for everything, including homes. Above all, political and social certainty is lost. How would you like to live in an economy without memory, where you don't know the price of anything day to day or the value of the wage you are paid? That's what it's like under the hyperinflation. Luckily, hyperinflation is still not a certainty to the US, but the chance is always there. How can America escape this fate? Well, the Fed is already doing everything it can, raising the interest rates. By raising interest rates, the Federal Reserve can make dollars more expensive and reduce consumer and business spending. Lower spending means lower demand, which can help ease pressured supplies. The US government can also impose prices and wage controls that make it illegal for prices and wages to climb over specific levels. But this approach doesn't always work, as history shows. In 1986, President of Brazil, José Sarney, instituted an anti-inflation program that froze prices, controlled wages, and lopped 3 zeros of the Brazilian currency. Plan succeeded in temporarily curbing inflation, but higher prices were quickly replaced by severe shortages of daily necessities such as eggs, meat, and milk. Black markets quickly filled the vacuum, resulting in higher prices that didn't show up in official inflation figures. Now the inflation in the US is the #1 problem, and it can take years for the Feds and the government to fix everything. Until then, we can only hope for their success. What do you think? Is hyperinflation a possibility? Or is it just another boogeyman? Write your thoughts in the comments down below. Like this video and subscribe to the channel so you won't miss any videos. Thank you for watching and see you in the next one.